You want to own the miners. Now, for us, we have to own the big miners, and the reason I say that is because, and we own the royalty companies too. But the reason I say this is because we're big enough to where when you got billions of dollars, you can't just go in and out of one of those little miners. If I had the expertise, and I know a lot of people that do, to own the smaller companies, I think that is where you're going to have some pretty good opportunity, because the big miners are going to buy them up. But yes, I think it's a bubble, and I don't want that to be your headline, because I'm not predicting a crash tomorrow. But I'm just saying that if we're in a bubble, we're in one now, and everything though, except metals and commodities, everything else is a bubble.
Yeah, I think it's important for you and for everybody watching. I'm not one of those sensationalist type people, so we want real factual information from the experts that we bring on. So
yeah.
It's interesting that you're talking about stories, because I also have a story, and I'm sure everybody does, but there's a friend of mine who was working for a communications company at the time called Level 3 Communications. You might remember them.
Know it well.
Yeah, and they fit the same model that you're talking about, and he ended up getting stock in the company given to him for working there. His portfolio zoomed to $17 million. I said, "Why don't you diversify?" And he said, "It's only going up." And when all said and done, he was left with $500,000. He lost it all except for $500,000, and he was already in his 60s at the time, or late 50s. So
well,
very
Gary,
sad.
I'm not being the bearer of bad news, but I've had so many stories like that in my career, just exactly like that. And the bad ones during the internet boom were they worked for public companies, and they got stock options, and what they didn't realize, they were non-qualified. So once you get a non-qualified, when you exercise it, that's a gain. And it's a short-term gain. And so unless you want to hold it another year. Well, they didn't. I had 3 or 4 of them. I had $30-40 million. They were all in California. I never will forget one across the desk from me said, "Hey, you guys, you think about earnings and profit and all that. Yeah, same thing. We're in a new paradigm now. That doesn't work that way." Those same 2 people that told me that ended up filing bankruptcy because the stock went so low before they could pay the tax. And I was saying, you're going to owe the tax either way, okay? You got to pay the tax, so get enough to pay the tax and maybe some more, whatever you want to do. But that's why rich people stay rich, and people that are trying to get rich never make it.
Those are sad stories, and it does feel like we're going to see another round of those. And hopefully this time around, people are more educated and more tempered in their psychology, that they're able to make those better choices.
Oh yeah, we've already seen it. Go back and look at from 19 to about 22 here, 2022. Go look at Zoom and Peloton.
Right.
Now, somebody along the way had a lot of stock options. My guess is they didn't do anything with them, most of them. Some of them may have. I'm not saying they didn't. But I have people come in all the time. I had a guy, I've had people come in, had a lot of Apple, worked at the company. I might as well take their firstborn child. I mean, they don't want to sell it. It's not a smart move, though. I mean, nobody knows enough to not do. Look at Buffett. He's selling Apple every quarter now.
Yes, he is. All right. Well, Ted, there was talk for so long. You kind of touched on this a little bit earlier, but there was talk for so long that there would be a market correction, recession, and yet it never came. What happens is, psychologically, is that people talk about it. They talk about it for so long, nothing happens. And then they decide at some point, well, nothing's going to ever happen. So their psychology changes. It cements in a whole new direction. But then it does happen, but they're not prepared. And the damage is catastrophic because they just believed so different. They were not paying attention to the numbers, to the math anymore. Is this a scenario that you could see happening and you're actually preparing for now with your own clients?
Well, we certainly keep a cash buffer just because we feel that's what you should do. When I say cash, we don't have it just liquid. We have it in really, really short-term treasuries. But the recession part was a rolling recession. we've had recession in certain categories. Look at auto sales, look at residential real estate, look at commercial real estate, look at multifamily. A lot of those things have really been in their own recession. I think that what people fail to see. What camouflaged it or covered up, Gary, was the stock market. They kept juicing the market. So it made it look as though everything was okay. But yes, to answer your question, I think in these kinds of times, and just look at the numbers. So all you have to do is say, okay, look, when the market gets at this multiple, you use the CAPE ratio or you can use a normal PE multiple and say our price to book value. Say how many times in the past have you gotten a big market from this point forward when you were that extremely stretched?
Yeah.
And it's minute. Bad. It doesn't mean don't go up a little bit, but it means that you're making a big bet on. It's like you're pushing all the money across the table and saying, hey, I'm going to put it all in this one hand.
So the interest in gold, you were touching on this earlier as well, has picked up substantially. The coverage has now escalated up to the global head level of big banks. Tony Pasquarello, Goldman Sachs global head of hedge fund sales, he stated last week this: with a break over 2,700, price action in gold remains superb. This is an asset that is whatever you wish it to be. And I'm certainly not looking to pick a fight with the underlying demand story. Michael Hartnett, the Bank of America's chief investment officer, he also stated last week this: the gold bull is driven by policy and inflation. Investors simply need to hedge inflation and the threat of a U.S. dollar debasement. Gold is heading well above $3,000 an ounce. What do you make of this coverage by the big banks on gold?
Well, I think they had to, Gary, because they're both up. If you look at silver and gold, they're both, and Bank of America had another one on silver as well. They're both up over 30% for the year. And if you're sitting there as one of those investment houses and you're not at least saying something about it, that's the trouble. Now, are they in buying it hand over fist? No, because you can tell that by the volume that traded in these stocks. They're buying them and they're up, and a lot of them hitting new highs, but nothing like they were on a multiple basis, say back in 2011. Mm-hmm. And so it's just sort of gotten started on that side. And I think you'll have these ebbs and flows maybe, and you'll have corrections in gold, silver, miners, but it should be something that's really good for an extended period of time. Now, what's extended? I don't know, 3-5 years, maybe longer. But I do think until you see it frothy, like you see now in the big techs, until you see it frothy, because all of a sudden CNBC's running in the morning. Guess what? Newmont's earnings are coming out today. We got to watch. Well, then you'll know. Then you'll know they're in it.
So, Ted, gold recently had a shallow pullback. That was before this week or so. That's been doing well. And since it's rebounded very nicely. In fact, the dips, they seem to be being bought up very quickly. How much strength are you now seeing in gold? And is there a corollary time period that this is reminding you of?
Well, if it reminded me of anything, it would be, you wouldn't remember this, but there was a newsletter back in 1980 called The Rough Times. And I can't remember Ruff's first, it was RUFF. But anyway, he was a gold man. He was a gold bug and failed to get out at the top. But, gold went all the way to 850 and people made a lot of money on it. But they didn't realize that it comes and goes. And so there's times to take some profits. And it's sort of like that now. It could very well have a lot further to go. We've done really well in our gold and our miners and our commodities that we own. But we're not, I wouldn't say we have a lot of hubris. We like, if we get to a certain point, we'll certainly wouldn't mind taking them off if we think there's risk involved. And, but yeah, I mean, I think it's under-owned though. Gary, that's what I got to boil it down to.
Yeah.
It's under-owned. I mean, these foreign governments are buying gold. They don't want the dollar. And I see more and more individuals call our firm and say, hey, where can I buy gold? Where can I buy gold? Where can I get this or that or the other? And I think people are all of a sudden starting to say, maybe I need some gold, some really hard money. And, but it's just started really. I know. I think the people have been in it the last 3 or 4 years, like us, we're sort of alone. We don't have that big push yet. When you see the stocks really bubbling, hitting new highs, and the cash, the price to cash flow goes back like they were in 2011, you'll know it's time to sell something. But it's not even close.
I couldn't agree more. So several factors, you've touched on a few of them, have driven gold's record run here in 2024, including de-dollarization. That's picking up pace. Unchecked government spending. That's picking up pace. Soaring interest on 35.5 plus trillion in U.S. debt. Central banks stockpiling gold at rates we haven't seen in 50 years. The Fed reverting to its old playbook of easy money. Ongoing wars, extreme geopolitical tensions that are escalating. I mean, the list is so long. In your analysis, does gold's ascent keep on going? Like the trend is your friend, and what is and in your opinion, what's likely to halt gold's upward trend eventually?
Well, I think one of the things that's different now, Gary, is really since 08 and 09. And I'm a big fan of the U.S. Don't get me wrong. I think it's certainly a land of opportunity. But I think a lot of the Western countries, a lot of the Western European countries, the West, the U.S., that their empires are declining. I call them an empire because I think they built up so much in the government and everything that they're in declining mode. And I think people look at that and think, I'm not certain where this is going to be in the next 10, 20, 30 years. I've got grandkids. I mean, there's a lot of questions going in people's minds. I think that's the difference between now and these other periods when gold was coming. We weren't a declining empire. And I don't mean that. I'm trying to be as realistic as possible. I'm not trying to run down the U.S. or anything like that because I'm a veteran. I've done my share.
Well, thank you for your service.
But I would say to you that I think people look at it like that. Realistically, they look at it and say, it's not the same. And I can see this decline. I see that, and I worry about my children and worry about my grandchildren. And I think that's part of what's going on here, okay? And to a degree in the Western European countries. But that to me is the one difference between now and what it would have been before.
Do you have a recommended allocation for gold that you prefer? I know that Ray Dalio has publicly stated 10 to 15%. Some of the people that I've had on here have been in the range up to 5%, and some have been as high as 20%.
Well, I think for us, I'll just give you, we have 3 strategies, and one is a conservative fixed income strategy. It's really almost bulletproof. It's very short-term maturities, but we own between 5 and 6% gold, just the bullion in that portfolio. Then we have a stock portfolio on the other end, and it just has some of the royalty companies as a stock, okay? Because there's no capital expenditures, and we really like that. In the middle, we have a high income account, and that's where we own most of our commodities and that sort of thing. It's high between the miners and the gold just itself. I mean, we're 12% or so, 12, 13, 14%. It's gone up and climbed into that level. But I think if a person's going to start, if you don't own 5%, then why would you own it at all? I mean, you got to own enough to where it's really and truly a hedge. And you might want to mix it. I mean, there's other things out there, palladium, uranium. There's a lot of things that we don't have in this country. And I think that's where people really miss it. This commodity thing, we don't produce the right things here. That we produce oil, don't get me wrong, and natural gas, but a lot of those things we don't produce enough of, and so they probably go higher in price too, along with gold.
So Ted, gold, as we've been talking about, it's broken through the inflation-adjusted all-time high of 2,700-ish. And for silver, despite trading around $33, $34, it's still way below its inflation-adjusted all-time high. In fact, it's below its nominal high of about $50 back in 1980 and again in 2011. But in today's dollars, the inflation-adjusted high for silver is more like 170 or even a little bit higher than that. So silver would have to rise about 5 times from its current price to hit the inflation-adjusted peak. It would have to double in price to hit its 2011 high-ish. With gold having surpassed its inflation-adjusted high, do you see that being in the cards for silver at some point in the near future?
Well, I don't know if it does at this time, Gary, but in the past, when you got these things going, silver outran it. Silver really, I mean, it gets hot and really moves higher a lot. We haven't gotten to that stage. That's what I'm saying before. We haven't gotten to that stage where everybody's, I got to have some. I got to have some of the miners and silver. We're not at that stage. But when you get there, silver typically is going to have a bigger move because gold moves, it's sequentially moving higher all the time, you see. And then all of a sudden, silver just catches up with it. In the past, that's what happens. Whether it happens this time, I don't know, but it doesn't hurt you to own some silver.
Yeah, it's late cycle. It's usually an 8 to 12 month run, and it's explosive.
Yeah.
So some analysts, you've touched on the miners. Some analysts are reporting that there's a huge disconnect between gold mining stocks and the metal itself. They're calling it the golden value gap, and they're saying it's probably the decade's biggest opportunity. What's your analysis pointing to? I mean, is this something everybody needs to have exposure in?
Well, I think you want to own the miners. Now, for us, we have to own the big miners, and the reason I say that is because, and we own the royalty companies too. But the reason I say this is because we're big enough to where when you got billions of dollars, you can't just go in and out of one of those little miners. If I had the expertise, and I know a lot of people that do, to own the smaller companies, I think that is where you're going to have some pretty good opportunity because the big miners are going to buy them up. They can go buy them cheaper than they can go mine it. And I think as the prices go up, and if you were a person that really knew the industry, and there's a number of people that do, I don't know the junior industry. I know the big ones, but I have to have the companies that we can move in and out of, but that I could see the big miners really going up, and then I could see them buying the small ones, and if you have a good handle, I own some that have been recommended by some of the really good people in the business, but we don't own them for clients. Is that I'd have to buy half the company, and I'm not going to do that. But anyway, I think there's some real opportunity on both sides. But for people that want to be a little more conservative, you just stay with the biggies.
So staying on the miners here, Ted, in a recent Ernst & Young survey of mining companies, it was found that their top risk is the lack of capital that they've been experiencing since 2011. Yeah. As with oil, starving miners of capital when their products are vital to civilization, it all but guarantees higher prices ahead, right? So is this the scenario that you would expect to happen?
3 years ago, we did a report. We looked at all the big miners, okay, and look, they had all cleaned their balance sheets up a lot, Gary. They looked better than they had in ever, really, almost. Their price to cash flow was cheap. It was back like it was way, way back. And so we knew that eventually has to change. Well, the price to cash flow in these companies is still low relative to where the high ever was on these companies. And so, yeah, I think what happens too is, and this is unfortunate, but any business on Wall Street, when the prices go way up, the capital comes in, but it comes in at the wrong time. It comes in, when gold's already, let's say gold's 4,000 or 5,000, then you'll get a lot of capital. But you're having to put the capital in when prices are really, really high. That's Wall Street for you. You get oil at 100. We had back there in the day when it was 220 and whatever, 150, both times. They just poured the money in. Well, that's just Wall Street, and they'll get the capital, and I think they're getting more capital today. But there's still a number of those companies that are capital starved.
Mm-hmm. So with the fiscal and credit mess that the U.S. and other Western nations are in, do we want to just load up on these real things that are in limited quantities that government can't print, create, or inflate the quantity of, and ride things out until basically things get so chaotic that the masses pile into them? Basically, in essence, front run the masses no matter how long it takes?
Well, I think you have to decide if I'm going to be in all the metals, and all of those types of commodities, And for us, that includes natural gas, it includes oil, gold, the minor, everything. But we also have copper, iron, a lot of different things that fit in them. They were public companies. But for us, when we buy those, we really buy them with the idea that we're probably going to own these for many years, quite a few years. We try to own all of our stocks if we can for 5 to 10 years at minimum. We don't always do that, but that's what we try to do. I think people have to look at that and say, okay, am I willing to, whatever I'm willing to allocate here, 5, 6, 7%, I think I'm going to allocate it to some to the bullion and some to these other metals. And I've got to be willing on that. It's like I've advised people on Bitcoin. They always ask me about Bitcoin. I said, well, all I can tell you is this, just buy 2% of it and forget it. Okay. I don't know what's going to happen to it. It probably could, go really high. Could, because there's only a certain amount of it. And I would be the last person to tell you I know anything about it other than the fact that I know generally what everybody else does. But, you have to decide what you're going to own and stay with it and not get kicked out on the first downtick. Like if you have that part of your portfolio downticks 10 or 15%, gold has much less downside, even in bad markets. It goes down, but nothing like the stock market. And you have to just decide, I'm going to stay with it, whatever my 5% or whatever my allocation is, you're going to have to just stay with it. If you don't, you'll drive yourself crazy because you'll look up 7 or 8 years down the way and you say, gosh, I have people today say, gosh, I could have bought that gold for like 1,100. That's sort of, that goes to their head. I bought a little bit, but I should have bought a lot more. And but that's what you have to stay with it, really.
So the miners, they could be volatile, but gold decreases volatility within a portfolio, correct?
It does. The miners, a different story. I mean,
right.
My friend Larry McDonald has a sort of an equation he uses when he looks at GDX versus GLD, the gold to the miners themselves. And I don't have it in front of me, but it's good though. It gives you an idea. Well, that's not in play right now. The miners are still a buy. And by that, I mean, you have to look and see. We used to do this at oil and gas companies. If the companies ran way ahead of the price, I'm talking about like 3 to 1 or something, we sold some of them because they're too far. That's not where we are today with gold miners, but you'll get that way eventually. And when you do, that's your signal that, hey, this has gone up a lot more than that.
This has been a fantastic conversation. Before we wrap up here, and I asked Ted our final question, I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote, and it's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Ted as much as I have. Please let him know by hitting the like and subscribe button and leaving a comment below the video. It's now time for our Golden Nugget segment. Ted, let's discuss portfolio positioning. We've kind of been dancing all around this during this hour, but based on all that we've discussed today and with your experience, your worldview as the backdrop, how do you recommend positioning for the next 12 months? What assets do you like and what assets do you absolutely want to stay away from?
Well, I think you have to have a fairly high degree of short-term treasuries. You're going to have to be where you can be nimble enough. And I think that's what people don't have today, but I think they should have that. You'll get paid well for them right now. 90-day, you're almost 4.75%. So you're okay to have that. But if you're looking at an allocation, like I say, we have 3 portfolios. But if somebody walked in and said, hey, I've got X amount of dollars and I want, we would say, well, we'll probably allocate you a little lower to the stock portfolio than we normally would. And I know we would actually, probably about half of what we normally would. We'll allocate you right now a little higher in the high income account which are things that all pay high cash flows as far as dividends and interest. And then we'll also do some conservative. All we're trying to say is we lean toward being a little bit safer now. You need to be safer now. And let's say we're wrong, and we could easily be wrong, by the way. We've been wrong before, and we're wrong. And the market goes up, ticks up another 10% or so. That's okay. I think what you have to remember is you're trying to live to play another day. You're not trying to win this last 5% in the market or 7% in the market. And don't believe what Wall Street says to you, because they've got you believing that, hey, you can put it in, forget about it. But I think whatever how you want to do it, and it depends on the size. People, obviously people with 100 million are going to be different than people with 2 million or, or less. But I think people need to think about it like that. Doesn't mean you won't get growth and you won't do well. It just means that you won't have it all in. And maybe you go to a cocktail party and they give you a hard time about it. But let me assure you, you go back 2 years later, you might be the person that says, hey, should have listened to me. You never know.
Well, Ted, thank you so much for coming on to Metals and Miners and for being so generous with your time, analysis, and ideas. It's been awesome to spend the time with you. Would you share with the viewers any important message you want to leave with those tuning in, where they can learn more about the work that you do and how they can connect with you?
Well, Gary, everything we do is at the website, oxbowadvisors.com. And we're transparent. We don't try to hide a lot of things. People will say, oh, that's proprietary. I kind of dislike that word because they're going to find out about you one way or the other. But it's we're pretty wide open. Look, and so you'll see our mistakes, and you'll see the things that really work for us. The big part of it is this, and I talk to people about this all the time. If you've had a liquidity event over the past 5 years, or you have a lot of money now, you need to be concentrating on not losing it just about as much as you are as making more, because that is your big risk right here. And that's the thing that I would mention to people for sure. But you can see everything we do, the books, we'll be glad to send you a book, newsletters. We do a lot of videos, different things, but you can get it all at the website, oxbowadvisors.com.
I'm going to have all the information up on the screen. There'll be links in the description that everybody can click through. I've been following you, Ted, for probably 3 or 4 years now. I really appreciate, the openness and the sharing that you do across many channels and across many different types of media. You're very measured. So guys, if you haven't been following Ted, you really need to. Ted, I look forward to having you back on sometime soon. And thank you for being here with us and everybody else. Thank you for watching.
You bet, Gary. Thanks.
I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote, and it's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History nor Economics. This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us.